In 1931, a loaf of bread in America cost half what it did 2 years earlier, and millions lost their jobs. Governments panicked, banks collapsed, and farmers burned crops they couldn't sell. The world thought cheaper prices meant relief, but it became despair. So why does falling cost of living make life harder, not easier? Let's find out. So what exactly is deflation and why do economists fear it? Prices fall. That sounds like good news, right? Groceries get cheaper, gas costs less, rent drops. But history shows that when prices fall for the wrong reason, everything else collapses with them. Economists define deflation as a general drop in prices across an entire economy. It often starts quietly after a boom. Companies overproduce, consumers stop buying, and businesses cut prices to move products. What begins as a small correction soon spreads. Lower prices shrink profits, so employers reduce wages or lay off staff. With less income, people spend even less, pulling the economy downward like a whirlpool. The world has lived through it before. During the Great Depression of the 1930s, US prices fell about 25% in 4 years. Wages collapsed, farms went bankrupt, and unemployment hit 25%. Franklin D. Roosevelt later said in 1933, "We have nothing to fear but fear itself." But that fear, the fear of spending, was already paralyzing the country. Japan faced its own deflation trap 6 decades later. From 1991 to 2001, the Nikkei stock index dropped 63%, housing prices halved, and consumer spending froze. Economists called it the lost decade, but it lasted far longer. The Bank of Japan cut interest rates near zero, yet demand never fully returned. People learned to wait for prices to fall further before buying anything. That simple habit kept the spiral alive. Deflation punishes borrowers too. When prices and wages drop, debt grows heavier in real terms. A $200,000 mortgage in 2010 still demands $200,000 back, even if your salary falls. That's why central banks panic when deflation appears. They know how quickly it turns confidence into survival mode. But why does money gaining value make life harder? To understand that paradox, we need to see what happens when saving feels safer than spending, and growth starts moving backward. When money gains value, but life gets harder. In 1932, a man could buy a brand new Ford for $500, but few had $500 to spare. Prices kept falling, yet everything felt more expensive. That's the strange reality of deflation. Your money gains value, but life gets tougher every day. When prices drop, it sounds like a reward. Groceries cost less, gas is cheaper, maybe rent too. People think, why spend now? It'll be cheaper next month. That small thought spreads fast. Businesses start losing customers, so they lower prices even more. Profits fall, workers are let go, and soon, the same person who planned to buy later has no paycheck at all. This cycle fed the Great Depression. Between 1929 and 1933, US wages fell by 42%, while prices dropped 25%. Even those still working earned less every month. Farmers poured milk into ditches because they couldn't sell it for enough to cover costs. Banks closed by the thousands. By 1933, over 11,000 banks had failed across America. Japan repeated this decades later. After its economic bubble burst in 1991, property prices collapsed. Home values in Tokyo dropped more than 60% over the next 10 years. People saved instead of spending, expecting things to keep getting cheaper. The government slashed interest rates, but it changed nothing. By 2001, Japan's average annual GDP growth had sunk below 1%. Deflation turns the idea of progress upside down. When saving feels smarter than buying, economies freeze. Businesses can't grow, debt becomes heavier, and hope quietly drains out of everyday life. So, central banks learn to fear it. They learn to act fast, sometimes too fast. In the next story, one decision by a major central bank in 2008 changed global markets forever, flooding the world with $4 trillion and rewriting the rules of money itself. Why deflation scares central banks more than inflation? In 2008, the world's biggest banks were on the edge of collapse. Lehman Brothers had just gone bankrupt, and markets froze overnight. Prices started falling everywhere: homes, oil, food, even wages. The Federal Reserve saw what few understood at that moment. A deflation spiral had begun, and if they stayed still, it could destroy everything. For economists, inflation feels uncomfortable, but deflation feels deadly. Inflation erodes savings slowly. Deflation wipes out economies quickly. When prices fall, debts grow heavier. A $1,000 loan still demands $1,000 back, even if your income drops by half. During the Great Depression, that exact trap pushed thousands of families into foreclosure. The same fear resurfaced in 2008 when housing prices in the United States dropped nearly 30% in just 2 years. The Fed moved fast. In November 2008, it launched an experiment called quantitative easing, printing digital money to buy bonds and flood the economy with cash. Over the next 6 years, it created roughly $4.5 trillion. The goal was simple: make people spend before prices could fall further. Central banks in Europe and Japan copied the move. For a while, it worked. Stocks rose, housing recovered, and inflation returned, but at a strange cost. Cheap money fueled record debt and massive inequality. Corporations borrowed heavily to buy back their own shares. By 2015, global debt reached $199 trillion, nearly 3 times the world's GDP. Economists began asking a new question: had the cure created a new disease? That question still haunts policymakers today. Because as technology makes everything cheaper, central banks face a new kind of deflation, one they can't print their way out of. So what happens when innovation itself starts pushing prices down faster than money can keep up? And the very progress meant to save us starts quietly reshaping the economy. Can technology cause deflation too? Look around. Phones replace cameras, watches, even wallets. A single app does what 10 devices once did. Every upgrade makes life cheaper in ways we barely notice. That invisible efficiency creates what economists call technological deflation, progress that quietly drives prices down. This trend didn't start yesterday. It began decades ago. In 1965, Intel co-founder Gordon Moore noticed that computer chips doubled in power every 2 years while costs stayed flat. His prediction became Moore's law, and it changed everything. From that point, technology didn't just improve, it multiplied. A smartphone today holds more processing power than NASA's computers during the Apollo 11 mission in 1969, yet costs a fraction of what a personal computer cost in the 1980s. So why does that create deflation? When products become better and cheaper at the same time, companies make less profit per sale. Consumers delay buying, expecting lower prices later. That same logic that froze Japan's economy in the 1990s now spreads globally. Televisions, phones, laptops, each generation offers more for less. By 2020, the average price of a flat-screen TV dropped nearly 96% from the year 2000. Technology also cuts labor costs. Automated warehouses, driverless trucks, and AI software replace millions of routine jobs. Productivity rises, but wages lag. When wages stop growing, spending slows. That gap between progress and pay creates the same downward pull that classic deflation once caused. Central banks can print money, but they can't slow innovation. As AI and automation reshape entire industries, deflation is no longer an accident. It becomes built into the system. And as prices keep falling while wealth piles up in fewer hands, another question grows louder. What happens to debt, savings, and investments when money itself starts gaining value again? And the rich stop spending first? What happens to debt, savings, and investments during deflation? Deflation flips the rules of money upside down. During inflation, debt shrinks over time. But when prices fall, that same debt grows heavier every month. It's like walking uphill while the ground keeps sliding backward. A dollar tomorrow buys more than a dollar today, so every loan feels harder to repay. This effect hit hardest during the Great Depression. Between 1929 and 1933, U.S. consumer prices dropped roughly 25%. Mortgages and farm loans stayed fixed, but incomes collapsed. Farmers who owed $10,000 on their land now face debts worth far more in real terms. Foreclosures swept the Midwest. Entire towns in Kansas and Iowa emptied as families lost everything they had built. Deflation rewards savers, at least at first. Their cash buys more each year. But when prices keep falling, businesses fail, wages drop, and investment returns disappear. In Japan's deflation era, from 1995 to 2010, savings accounts earned almost nothing. Interest rates stayed near zero for over a decade. Households hoarded cash instead of stocks, draining life from the economy. By 2010, Japan's household savings rate fell from 15% to below 3% as people spent savings to survive. Investors face a similar trap. Stocks fall because profits shrink. Property values drop because demand fades. Only government bonds gain value, and even they pay less over time. In a deflationary world, cash becomes king, but kings rarely build empires by hiding their gold. Central banks fear that mindset most of all. Once people believe tomorrow's money will be worth more, they stop spending today. And that's when economies stop breathing. So how do governments break that cycle? And what happens when printing more money to escape deflation starts to damage faith in the money itself? Can printing money fix deflation, or does it create something worse? In 2020, the US government injected over $5 trillion into the economy in less than 2 years. Central banks across the world followed the same script. Flood the system with money to stop prices from falling. It worked at first. Markets recovered, spending jumped, and jobs returned. But there was a cost waiting under the surface. Printing money sounds simple, but every dollar created without new production behind it weakens trust. During the pandemic, governments pushed out stimulus faster than at any time in modern history. By 2021, U.S. inflation shot above 9%, the highest in 40 years. Central banks had escaped deflation, but they had overshot the target. What followed looked like a new kind of imbalance. Wealth concentrated, assets inflated, and basic goods more expensive than ever. Economists called it post-deflation shock. Cheap money lifted the stock market and real estate, but ordinary wages lagged far behind. By 2023, global debt had passed $307 trillion, nearly 3 times the size of the world economy. Every policy aimed at saving the system made it more fragile. Deflation had been the fear, but debt became the trap. Governments can't print trust, and that's what economies run on. Once people start doubting the value of their currency, they rush toward alternatives: gold, real estate, and in recent years, digital assets like Bitcoin. In 2025, as inflation cooled again and whispers of deflation returned, Bitcoin traded around $66,000. Many saw it as a hedge against both extremes, inflation and deflation. But few understood what that meant for the future of money itself. Because the next battle may not be between rising or falling prices, but between old currencies and new systems. And one technology is already preparing to challenge them both. Every price, every paycheck, every policy connects to one hidden story: deflation's return. Click the next video on your screen before it disappears. Another unseen chapter of the economy waits to be revealed.